So it's just a quick update on the M1 portfolio. I think in light of what I talked about the other day, was we're seeing GPS on a little bit of a breakout. Like I had said, the market looked like it was poised to break out, and GPS was holding 13, so you can see that right here for the most part. Hit 13, hit 13, hit 13, and it kind of wedged, and then of course retested. You can see the retest right there in this green candlestick. And so now the market is going up. I'm not really a fan. Forgive the traffic. That's that first floor life. I'm not really a fan of the gap, but I bought the gap and started scaling into the gap down here when it was at 7 and 8s and 9s, and I have been buying it up ever since. And there's definitely going to be resistance at the $16. So like I said in my previous video, that I was looking to scale out of the gap, and so that's basically my sell. I decided to sell half of my gap position, and just take half of the profits. Currently I'm up $200 on the 500 that I invested, so it's not exactly a bad return. So I'm taking half of that off the table and adding some of that back into Prudential and putting in about 250 into Dave and Buster's. I kind of like Dave and Buster's. Again, I don't know where the gap is going to go. I just know during the bull market run of 17, 18, and 19, and even parts of into 20, you can see what the gap was doing, right? So this is basically a loss of principal. For all I know, for all intents and purposes, the market could decide they want gap to go back to 34 for whatever reasons. But just looking at the play over the past from basically 19 into the end of 20, it looks like the gap was kind of holding 16s. I think that the market will retest 16s and then maybe come back off. That's why I'm only taking half of the position off, and I'm taking it off on a day where the market is up. We're up 73 cents, another 5%. So wherever the market closes by 3 o'clock, wherever the stock closes, I'll take half off. And then, of course, some of that is going into, like I said, to Prudential. I do like Prudential. Man, wish I was watching this yesterday and it came down to 64s and I put my buy order in and I put it in too late, and look at the run up. I've already been up 7.5%, but it kind of is what it is. So I've got another buy order going in for Prudential today. And of course, Dave and Buster's play is basically where I'm going to be. Damn. Basically where I'm going to put a little bit more money in with the run up. Not quite sure where we're going to go, but I do like the way the stock looks. It's coming in on volume that you can see right there. The volume is looking pretty good. And of course, Dave & Buster's up nice and strong. It is one of those companies that was depressed. And for the most part, it wasn't doing fantastic in 17 and 18. We're seeing a little bit of a little sketchy ride, but you can see right here, it seemed to be holding $40, right? So multiple times here and here and here, and then for the better part of most of 19 into 20, Dave & Buster's looking like it was holding 40, poised for a breakout, which it did, and then the pandemic hit, right? So that's basically why I'm putting more money into this play, and also into Prudential. Primary Prudential, I like Prudential. It pays a good dividend. It's a successful company. I know they deal a lot with like pension funds. So there's always going to be a stream of, especially recently, the hospital that I work at, they completely moved, the entire network moved into Prudential. So that's billions of dollars from all, basically the entire, I think it was the entire nursing union moved in. But it does pay a good dividend. They had been earning fairly solid. I do think I'm just kind of, I should say I am scaling in, because as you can see, $65 was for the better part of 10, 11, 12, and it finally a breakout in the middle of 13, and then we see a retest right here at that $65 level. And it's kind of what I talked about the other day, that the stock was holding below that area, and finally we saw a little bit of a breakout, and then it recoiled back down here, gathered some more steam, and now we're heading on our way up. I wish I had been paying attention to this a little bit earlier, but it is what it is. Sometimes you can sometimes there's just too many picks. Sometimes there's just too many picks, and you never know when a stock is going to break out. Ladder, I am probably going to scale out of at some point. I do think it will return in good times. I think Ladder will do well. In unsure times, not quite sure. It is holding $7. I am putting in more money. I think I will eventually scale out because they're paying out too much for their dividend. I think they're close to 100%. I do know that they slashed the dividends, which I found to be very good. You can't sustain paying out over 100% of the income. It just does not. It's not sustainable. What I do expect is expect the company to restructure and basically to put in play what they feel will be financially healthy for their company. I do think that they will do that. Until I see that, of course, I'm a little bit sketchy, but I am adding a little bit back into Ladder Capital for the dividend. And that's basically a little bit of an update. I do have a little bit more going in. I've got a couple of buys going in for today between Prudential, the half sale on the Gap. As you can see, I'm going to be taking profits there, and I'm already up in a little bit into Dave & Buster's. We're up almost 16%. Is that for the day? Yeah. No, it's overall. But I do want to scale in. I do want to scale in a little more. MGM having a nice run up. I spoke about this several times. I think I will keep this one with a huge rip and a huge sell-off. We're seeing a lot of volume coming in. I'll wait and buy a little bit more on the pullback. I know a lot of people are going to be taking profits. We're seeing basically a retest of 24 as the resistance. And then, of course, people are just, this is just how buyers and sellers are. Once things come into a resistance point, just like myself, people are like, you know what, I should probably start scaling off. And it's just supply and demand. As people become more fearful, they start taking profits off, and the stock just falls. And if it doesn't have enough buyers, we'll have to wait and see which direction. I think MGM, in terms of a business, will do okay. I do think they will come back. At some point, they did pay a very modest dividend, but I'm basically holding on to this one to see if we're going to come back up. I think, well, like I said, 24, you can see why, right? You should be able to see why it's hitting 24 all through here, and here, where we basically bounced off 24, and now 24 becomes the resistance. So this is typically how you can see it even back here, right? You can even see the 24s, where is it? 24 right here, right? So you can see it's multiple times throughout this stock's life. Back in 15, where it hit 24, came off, hit 24, came off, hit 24, came off, hit 24, came back, and then subsequently bounced around that $22, and then did a retest later on in the stock's future back in 19, and we bounced and bounced and bounced, etc. So a lot of times when I'm looking at fundamentals, is basically what will keep you in the stock, right? You like the business model. They have a good moat. They make successful and well-educated business plans. That in essence is what keeps you into the company, right? Just like a relationship. It's literally just a relationship. As long as I like the give and take of the relationship and I find the relationship beneficial, then I'll stay in it. If you start to see that you're not getting what you want out of the relationship, what do? We just walk away. I mean, we just walk away from the relationship, and that's the reality. During basically the highs and lows of this stock, we're seeing people that are just basically, they look back at the charts, and this is just what happens. The stock hits 24, and then that becomes your resistance or support. And that's basically how I make these plays. I look at the stock, I look at the financials. I think, does this company, will this relationship, this business relationship be of value to me? And then I look at the chart, and I'll say, okay, this stock right now at 24, it might not necessarily be a buy until I see a breakout on volume, right? That's what lets me know where to buy the stock. It's not just about whether the stock and the company is good, but it's about, is this a good time? Just like T. I talked about T a while back, looking at T on the weekly. All right, if you look at T on the weekly, for the better part of this stock, for almost 2 decades, the stock had a hard time breaking above $40, but for the most part, held above around that $20 to $22 range for the better part of over 20 years. And sure, during the run-ups, we see a little bit, but for the most part, we look back here, and you can see that just around $40, T, not really all that great. T in the 20s, people are a buyer. T up here, even though AT&T basically during the course of its relationship has had some good business ideas and some poor business ideas, and of course that is reflected. Of course, in the stock price, and that's basically how I look at plays. As I look over the financials, does this company have a good business model? Do I, at the very least, for the foreseeable life of, or I should say for the year, let's just say for the year, do I think that my principal will more or less remain stable? I'm not necessarily looking for growth. I might just be looking for the stability of my principal, right? The initial amount of money that I put in. I want to be sure that if I'm going to exit this stock at some point, I'm not going to see the stock look like this stock, right? I'm not going to come back to my dividend play and basically see my entire principal basically erode. This is not what I would want to look at a chart. For people who look at this and be like, yeah, I'm going to look at this play and I'm going to hold this for a year. You may come back at the end of the year and you may lose. You may gain some really high dividend, but you may lose your entire principal, and that's not the purpose of dividend plays. Certain stocks, like Verizon, has had some pretty nice run-ups, but their dividend pay isn't all that great. So that gives you a little bit of growth with a little bit of dividend in return. So that kind of makes up for not having, necessarily a really huge dividend, unlike, for example, like Iron Mountain. Looking basically at Iron Mountain, you can see for the most part, Iron Mountain, again, for over 10 years, had a hard time breaking $29, right? You can see that here, multiple times throughout the stock's life. And of course, and again, here, right? Here and here. So we're at a point in Iron Mountain's life where over the past almost, what are we looking at? 14 years. 14 years, the stock's been above $20, and it pays a decent dividend, but it's going through a little bit of a hard time, and they're more than likely going to cut their dividend, which I think they should, because they can't sustain paying out over 100%. It's just not possible. But for the better part of its life, for the most part, anywhere down here in the low 20s, Iron Mountain seems like a good buy. Way up here, not so great of a buy, because looking back at just like a person's history, right? Just looking at the person's history can kind of give you an idea of what's going to happen in the future. Same thing when you're looking at a stock. Looking at the stock's history, I can see, for the most part, investors do not think Iron Mountain above $40 is a good buy. And so what happens? The stock falls, the stock falls, the stock falls, the stock falls over and over and over again. And so this is what I typically look for when I like the stock and I like the dividend play. Then I think, well, where do I want to buy it? Where do I think the stock is of value? And so I pay attention, and I might scale in a little bit more up here, but most of my buying is going to take place down here for dividend plays. Now, for things like for growth companies like Chegg, you just keep on buying and buying and buying, even on the pullbacks, until the direction of the company starts making bad decisions, right? Same thing with things like Apple, right? Apple just not a dividend stock that basically looks like this. Instead, the stock looks like this. And as long as you believe in the business model, well, then you're buying, for the most part, all the way up, because you never know where the stock is going to go. I mean, there were people that were like, oh, I'm not going to buy it here, and I'll buy it when it comes down here. And a lot of people were selling here, and a lot of people unfortunately got out, and then the stock just basically rocketed back up. Same thing for me. When I was a seller down here when the stock was at 375, because the market re-hit 27K, and then the market pulled back, and that's exactly what we saw in the stock. And so I took my profits, and then the stock slingshot up another 70, 80 points. It kind of is what it is when it comes to long-term investing. Like they say, for tech stocks, for like the buy and hold, you're basically buying all the way up. But when you're looking for like your dividend plays, I typically want to buy when the stock is basically on a downtrend. When the stock is basically on the downtrend, and it's typically related to kind of like external issues, not necessarily problems that are related to the actual stock itself. And then I become more careful. I might scale out, wait for the stock to kind of base out, for some better numbers to come out, for the stock and the company to go into a better direction, and then I'll look for an investment. This video has been a little bit longer that I wanted to discuss. For the day, we're actually doing pretty well. We're up almost 3%. We're up almost 3%. A lot of the stocks, there are a few of the stocks like CCL, a lot of the like MGM had a big day, up 14%, up 10% in Play, up 10%, 8% in Norwegian. Again, like you can see, I'm into these cruise stocks, and everybody's like, I've seen so many videos like, this is not the time, cruise companies are going to go out of business. But with the market and many of tech being very overbought, investors are going to look for value. And so what they're going to look for these stocks that have been continually depressed throughout basically the pandemic, which would be like retail and entertainment, especially stocks like Dave & Buster's and the cruise lines that have been depressed. And you can see on a day where the market is up, but as on a whole, we're seeing a bit of a pullback into tech. I'm a little still underweight into tech. I do have a couple of small buys going in, but I'm going to be continuing to scale in. Same thing kind of with the dividend plays for the day. Biggest earners, I think, for the day, again, right? CCL, Foot Locker, retail, and of course a little bit into also, what's it called? Real estate. Real estate is also depressed, and so we're going to see people who are looking for bigger percent returns are going to be looking for those companies that are depressed. I mean, Apple goes up $10, $20 on the day, percent-wise for your money. You're not going to get a lot. But for these stocks, you can almost double your money if the stocks, of course, basically run up, which we've seen. We've seen CCL into the 20s. Like looking back at CCL, I'm going to end this video real quick. Looking back at CCL not too long ago was a $25 stock, right? So it can go back, and it can go back there very quickly for those who are looking for basically a quick run up. We saw that stock consolidated down here at $12, and then finally had a break, and then it retested the resistance of like $15 or so, and then stock slowly came back up, hit a doji candle, and then you should have been more than likely a seller on doji. Represents indecision, and then the market kind of sells off into a hammer and then hammers the stock back down. We see a retest at the very least. If you were scared and you didn't get out here, this should have been another opportunity for you to get out if you were thinking that, if you were swinging this for the short term. I do think the companies will do well, especially as the countries start to open back up. We'll see a lot of the politicizing of the virus will start to go away, and then a lot of these stocks that people are like, the sky is falling sort of situations, we'll start to see some fairly big returns. Again, this is just my opinion. Like I said, I've got a little bit of skin in the game in a lot of these different stocks that I've talked about, like Foot Locker. I want to see if Foot Locker does end up returning a dividend. It will probably be sometime. They did pay the dividend. They did pay a fairly decent dividend, and the stock didn't look too terrible for the most part. For the most part, we're seeing. Well, I'm gonna have to wait and see if it does come back. If not, I'll take my profits. If it comes back up, into the 30s, I'll just take my profits and put that into a better dividend play like Prudential or BEP. It's basically a quick update. For today. Mostly, I wanted to talk about the some of the buys and sells that I had going on for the day. I got some small buys, as you can see, going here. Like I said, putting a little bit more money into Play and shifting some of that money into Prudential, and then taking some profits in the Gap, basically to fill some of these orders, and then add in a little bit of cash on the side. I'll have to wait and see. I'll probably do another one of these maybe by Friday. I'll put in another video maybe Friday morning, because this is my weekend at the hospital to work. But I'm basically going to leave it at that. It's been a little bit of a long video. But anyway, thanks for watching. If you have any questions, feel free to leave them in the comment section. And of course, if you like the content, feel free to like and of course subscribe so that you don't miss out on future content. Thanks for watching. Have a great day.